Hi guys, we're going to have to record the final review lecture, and so we're going to be looking at this. We're going to spend some time together here, as I mentioned in our last class, just looking at some of the key elements together of the final review, looking at areas that I know you're going to see a fair amount of questions on the exam for. That does not mean that you should not plan to see other areas, but we have a limited amount of time to go through certain things in the final review, and I do know there's some core things that I want to cover here. Make sure that you are still going through all of your final review book, and I showed this to you last time. You should have ordered this, so you should have this book available so that you can go through the final review. And just to take a look at the different sections, we're really going to focus down here in this section 5. Okay, and even though it's titled Operations Management, there are some key parts that have long been part of the CPA exam: cost accounting, budgeting and analysis, forecast and projection, with the big area there being variance analysis. So I'm going to focus down here in section 5. We talked about information technology in our last class, and some of these other areas. There were quite a bit of flashcard that we talked about during the course. So of course you need to make sure that you have the flashcards around this, and then, as I mentioned, make sure you're working all of the multiple choice questions, task-based simulation in your final review. In fact, let me just one more time to make sure that we are sure where that is in our material. Let me go back and find my software. And we were looking for the final review right there. Okay, make sure you're working all of that stuff that's in there. You don't have to watch the lectures. If you want to, they have some of the national lectures talking about some of the different areas. If you want to watch them talk about that, that's fine. I'm not sure that that's the best use of your time at this stage as you're prepping for your exam, but it's something that you could do if you want to. But you absolutely need to be working the multiple choice questions, the task-based simulation that are embedded in there in your final review. And it goes through by the chapters that we were talking about here, sections, whatever you want to call those, that they were talking about here. And then, of course, as I mentioned, we're going to spend some time right here. Okay, so let's go ahead and find that. And I'm going to be well accustomed to me doing. Going to put myself in tablet mode here, and I'm going to change the view a little bit. Okay, and let's go ahead and find that section, which is clearly down a bit. Okay, and I apologize for making kind of sit here and watch me scroll through, but you're used to that. Okay, all right, good. So this is the section that we're going to focus on, and we've got this performance measurement section here up front, and they start talking about financial measures, non-financial measures, and then here come the ratios. Okay, guys, so I'm not going to spend a lot of time with those. Again, you should be working the multiple choice questions consistent with the material. In each section, there are class multiple choice questions, and as we go through, starting with section topic B here in section 5, we will work those together. So you see them here. You can see the multiple choice question indicator. If you're looking at them here, you can always look them up in the software if you're trying to find the answer to those. But as I've said now a couple times, I do want you to make sure and work all of the multiple choice questions that are embedded in that section there in the software that I showed you. So when I'm talking about those, I'm not talking about these. I'm talking about the one, but these are part of those, but you definitely need to go in the software and work those. Okay, I think that's pretty clear. So let's just go ahead then and let's start to take a look at topic B, cost accounting. Okay, and let's review what we talked about during class, the notion of product cost versus period cost. Okay, let's just look at these, product cost versus period cost. And remember, we said that product costs are composed of direct materials, direct labor, and manufacturing overhead. By the way, guys, I'm not going to call out flashcards because I've already indicated to you what flashcards I want you to make. And it seems a little redundant for us to be looking at something here a second time in the final review, me covering it, and you not understanding that this is very critical stuff that we're talking about here. So even though I may not be calling out flashcards, don't take that to mean that it's not important. This is clearly important stuff because I'm covering it here in the final review, right? So product cost, okay, are direct materials, direct labor, manufacturing overhead, are inventoriable and traceable. Okay, so that's really telling you that our product costs are going to be traceable or at least applied to the product. Okay, and notice they talk about how it works through the work in process, from work in process to finished goods, and then from finished goods to cost of goods sold. So that's basically telling us that our product costs are going to first reside where? On the balance sheet, and then as we sell the product, they will go to the income statement in the form of our cost of goods sold, right? Okay, so balance sheet for inventory, finished goods. Okay, see if I can draw that over, right? And then over to our income statement in the form of cost of goods sold. Now, period costs, by contrast, are what? Period costs are costs that are not inventoriable, okay, such as selling, general, and administrative expenses. Those go what? Those go straight to the income statement. Okay, so just to be consistent with our color, we'll use red for income statement. Okay, so what happens? Our income statement takes the cost of goods sold for our period cost, but it comes off of the balance sheet, whereas our selling and administrative expenses go straight to the income statement. Okay, now we have our manufacturing cost. Okay, and notice some synonymous terms here, or some different terms that mean the same thing. Is that synonymous? Okay, so now we're saying that our product cost can be called manufacturing costs in the form of direct materials, direct labor, and manufacturing overhead. So manufacturing costs include what? Include all of those things that are product costs. So sometimes you feel a little bit like, hey, you know, how come I'm sitting here and I'm hearing the same thing twice, right? Okay, and or the same terms being called something different. Well, that's because sometimes they call the same thing something different, and you need to know that, right? So you can call that AKA product cost, right? What is it? Arose by any other name? Okay, so the manufacturing cost can also be called product cost. Product cost can also be called manufacturing cost. And notice that our manufacturing cost can be both direct and indirect cost. In other words, what the direct costs are going to be our direct material, our direct labor, and then our indirect costs are going to be in the form of our manufacturing overhead. Okay, so one of the things, not so much for us, but we need to keep this in mind for my students that are just learning managerial cost accounting. This drives you crazy at first, right? Which? Well, it's same thing, different name, okay, is all that's going on there. And then again, our non-manufacturing cost, okay, our non-manufacturing costs have no relation to the manufacturing costs, such as advertising, cost of salaries, sale personnel, etc. And again, non-manufacturing costs, which we can call selling and administrative costs, are going to go straight to the income statement. Okay, good. Now let's go ahead and look at cost behavior or cost objects here. Okay, cost behavior is going to be that costs can be direct, means they are easily traced. Okay, so direct costs, direct materials, direct labor, easily traced. Okay, and the materials that go in to building a wooden table, easily traced, right? The labor that somebody spends building that table, easily traced to the cost of that table. So that tends to be direct materials, direct labor. Indirect costs, they say, are not easily traced to the cost pool or cost object to the product. Okay, so they're still product costs, but they're not easily traced. Now, I think one of the things, being accountants, we want things to fit into these perfect little silos, right, called T accounts for us, and they want them to fit directly and be easily traced, and not everything is easily traced. So we think that there should be some definition somewhere as to what is easily traced. Well, look, that's not quite the deal here. If a company comes up with a way to easily trace a cost that has traditionally been considered indirect, then it becomes a direct cost. So it's really in the judgment of the entity to determine whether or not the cost of directly tracing a cost is worth the benefit of doing that, as opposed to treating it as an indirect cost. And for an indirect cost, of course, it's going to have to be applied to our product. Okay, so let's just take a look here at some of the examples of indirect costs, and it includes, and some things are easy to know that they're indirect because we put the word indirect in front of them, such as indirect materials, indirect labor, and then you have the other indirect costs, okay, such as machine maintenance costs. Okay, let's just recall a couple of the indirect costs that we talked about a little bit. Depreciation is an indirect cost. Okay, so depreciation is going to be indirect. It's going to be treated as a product cost if it's depreciation on, say, the factory building. So you need to be careful, because if a problem calls out the depreciation on the administrative building, well, that obviously is, well, I don't know if it's obvious, that's why I'm reminding you, that is going to be what? That is going to be, that depreciation is going to be a selling and administrative cost, while the depreciation on the factory building is going to be a product cost, and work in process to finished goods to then finally on the income statement, cost of goods sold. Whereas selling administrative building depreciation is going to go straight to the income statement as an administrative cost. Okay, so you've got the factory building, what, utilities. Again, utilities that are applicable to production, like our machine using up electricity, whatever. We're making beer, the water, okay. Water that'd be more of a process costing system. But anyway, utilities. What else? Good example here. This is where I need you guys, where you'd throw in an example for me, but utilities is a good example. Rent was the other one I was trying to think of. Okay, rent on the factory building. All of these things would be considered sort of the other indirect costs that have to be allocated to our work in process. Okay, so that's what we're saying here. If you take a look, indirect costs are allocated or applied to cost pools using cost drivers that have a significant relationship to the incurrence of these costs. Okay, so when we look at these costs, we can put them into categories of direct cost, indirect. Okay, now you look at our cost behavior. Okay, and again, we're taking the same costs, guys, and putting different definitions on them depending on how we want to observe them, right? So when we look at our cost behavior, our cost can be variable, our cost can be fixed, and remember we talked about variable costs do what? Increase as the production increases, right? Whereas our fixed costs stay constant regardless of the level of production, right? The y-axis, x-axis. If they're looking at economics, we get ourselves a little crazy on, you know, what side we're on here. Okay, for our you know, cost behavior, cost accounting discussion, you know, we have, and it's going to go ahead, my software going to go ahead and start playing with me. Okay, but we have this X and Y here axis, and for our fixed costs we stay the same regardless. Okay, so let's just take a look at our variable costs, and they vary in production as volume increases or decreases, but remain constant on a per unit basis. So if our variable cost per unit is $4 per unit, it stays the same, right? $4 per unit. Whereas what on a total basis, it increases as our production increases. A fixed cost remains constant in total regardless of unit, but then will what? Increase or decrease as we produce more or less units on a per unit basis. So they're sort of mirror images of each other, and you need to take a look at that, make sure you're comfortable with that, because that's something that they like to trick you with on the exam. Okay, as we've said, depreciation is a good example of our direct costs. I should say our indirect cost, our fixed cost is a good example of our fixed costs. Direct materials, direct labor are generally variable costs, right? Okay, good. Now you come over and we talk about semi-variable, okay, or mixed cost. And what semi-variable costs, since we've gone with a graph theme here, tend to look like this. There's a fixed portion, but there's also a variable portion. For example, they talk about water and utilities. There's a fixed monthly charge, and then as you use more electricity, more water, you're going to have this variable component come up. But even if you sat in the dark all year, you'd still have this piece, which is the fixed piece. Okay. Now, one thing to keep in mind is that if you were trying to take a total cost understanding and you were sitting there talking about the behavior of most of your indirect costs, such as depreciation, such as your utilities and whatnot, they tend to look like this, right? Okay, this tends to be a good way to depict what's happening with overhead. So even though we're sort of showing you this here as a way of representing the mixed costs, I'm showing you that. Don't forget that with overhead, there's some variable components, there's some fixed components because the utilities are there in overhead. So if I was really trying to draw a picture of my overhead, I could also use this same sort of a graphic here that I'm using to show you our mixed cost. Okay, good. So let's go ahead and let's take a look at the question here, guys. And what I'm going to do, rather than let the tape run while you have time to work this one, I'm going to suggest that you pause the video, and then you can go ahead and come back and work this. After you work this, you can hit play again and see how we work it together. But I'll give you a second to pause. Okay, let's go ahead and let's look at this one together. Okay, all right. So we've got this. You can watch me continuously if you want, but I suggest you stop it, work the question, come back, press play, and see what we said about it. Okay, all right, good. So let's just take a look at this one. Applewhite Corporation, a manufacturing company, is analyzing its cost structure in a project to achieve some cost savings.
Which of the following statements are correct? Okay, and it's a little annoying when I look at these questions. Why do I have to be bothered with Applewhite Corporation? Just ask me which of the following statements is correct, okay? But you're going to have to read through that sort of introduction stuff as quickly as you can to make sure that you don't miss some key information that they might have buried in there. Okay, but it does get a little annoying. Who cares what the name of the company is? Okay, so anyway, let's take a look at which of the statements is true. The cost of materials in Applewhite's product is considered a variable cost. Okay, yeah, raw materials is probably a variable cost. And what I would do is I would just have a way of writing on my scratch paper, and it's very small, so you don't waste a lot of space with this. This one is true, because I don't know about you, I have the problem that I get through and I get to number 3 and I'm like, okay, now what did I say about number 1? And I waste time. So I'd have a way of indicating on your scratch paper that you've checked off 1 as being true, and since that's what they're asking, which is correct, which is true. The number 2, the cost of depreciation of Applewhite's factory machine is considered a variable cost. Because Applewhite uses an accelerated depreciation method for both book and income tax purposes. No, that's false. Depreciation generally is fixed. The only time that I can see depreciation truly in the fact that they use an accelerated, it's accelerated because we're going to depreciate it more quickly in its earlier years and later, more slowly in its later years. That has nothing to do with production. The only way I could see depreciation maybe being variable would be if we were using a units of activity approach for our depreciation. So we would have the depreciation per unit per level of activity, right? Okay, and then you multiply that times the amount of activity, then that might start to get us into a world where we could start to treat depreciation as a variable cost. Okay, but even that starts to get a little problematic, and so I doubt that the examiners would even go there with you. But certainly the fact that we're using accelerated, it has nothing to do with the number of units that we produce, therefore it is not variable. Okay, number 3, the cost of electricity, so that's false. The cost of electricity for Applewhite's manufacturing facility is considered a fixed cost, even if the cost of electricity has both and variable fixed components. No, we have a name for that. We call that a semi-variable or a mixed cost, as we saw on the previous page. So that is also a lie. Okay, so they said which is correct. 2 lies, 1 truth, so only. And guys, the reason we use 1, 2, 3 here instead of A, B, C is to remind you that the exam does not to give letters. They just have radio dials next to each one of the choices, so that you can select the correct radio dial, of course. Okay, and again, if you wanted to look at that question as part of when you're doing your final review, you will look at it when you can go through all those questions. You can see the question identifier up there. Okay, good. Let's talk about our cost of goods sold and cost of goods manufactured. Okay, and what I'm going to do, I don't know that you need to write all this, guys. I'm going to write it just so that we can have a little practice here, but you don't have to write all this. But I'm going to go ahead and just recall the way our costs work through our cost accounting system. Okay, it's so annoying. I don't know what the problem is. But I'm just going to roll with it and not let you listen to me complain here. Okay. So let's just go ahead and look at my raw materials, okay? And then I'm going to have my, I think I'll put my work in process right here. Okay, and if this thing will let me, I'll put my accounts payable, I guess, over here. You don't have to write this, guys. Just watch along, okay? You don't have to sit here and watch this. There's a page in the main book that has the T accounts already written in there. Okay, so you don't have to sit here and make copious notes on this stuff. Okay, but let's just review this. I'm just using this here on the page because I'm taking advantage of the space on this page to show you all this, so I don't have to go to separate whiteboard or something. Okay, so when we purchase raw materials, what happens? Raw material is like inventory, and so the things are going to be debited when we buy them. Of course, assuming we bought them on account, we would have the credit, right? Then as we issue and if it's direct materials will go to our work in process, right? If it's indirect materials, that's going to go to my manufacturing overhead. Okay, so let me just try to be a little more careful here. Okay, in other words, we will have a credit to raw materials as we use those. Okay, and if it's a direct material, it goes to work in process. If it's indirect material, I'm just going to abbreviate that, indirect, I guess IDM is okay, indirect material, it'll go to my manufacturing overhead. So if I'm using some glue for that table, since I can't trace that directly to work in process, I'm going to put it to my manufacturing overhead. Now what we're going to do later is we're going to have to apply that manufacturing overhead to our work in process, but we'll get to that here in a second. Okay, now let's say we have some direct labor. Okay, well, what are we going to do? We will have a credit to wages payable, salary payable. Somehow I think I'm going to regret writing it up here, but that's all right. Okay, so we'll credit salaries payable. And if it is what? If it is, see, I told you I was going to regret writing it up there. If it's direct labor, then it'll go to my work in process. If it's indirect labor, right? I have to pay the supervisor or whatever. Maybe I shouldn't have wrote that way up there. Okay, that's going to be my indirect labor. I'll put that as IDL. Okay, so we've got some labor, right? We've got some materials, but of course we're going to have to apply some electricity to that work, etc., right? So what happens? We have our utilities payable. We have our accumulated depreciation. Okay, and I don't want to go on and on, guys. I think that you get it. Okay, I'll do one more. We have our rent payable. If it was the rent on the factory building. Last one, okay. Property taxes payable. Sometimes you have to have the sanity to stop with things, right? So I'm going to stop there. And of course, these are all credits. Put payable there. And as we're crediting these various items, we will take these credits, okay, and we're going to debit them to my actual manufacturing overhead, and I call these the others, okay, right, because they're not indirect materials, indirect labor. So all of these would get credited to manufacturing overhead. Okay, so those all go to manufacturing overhead. Now we have a problem. It's kind of a problem, you know, easily solved. Okay, and that we're sitting here and we have what? We have these debits on the actual side, but we really need those to be what? Into work in process, but we couldn't take them directly to work in process because, hello, they're indirect. So what do? We sit here and we come up with a predetermined overhead rate. We're going to talk more about that in a minute. Okay, and we would basically use that to apply our overhead. So when we apply our overhead, we will go ahead and credit the manufacturing overhead as we apply that overhead. And when we credit, then we have our manufacturing overhead now is applied to our work in process. Okay, now by definition, direct materials, direct labor, manufacturing overhead by definition are called what? Product cost. We know that. They are also what? And I'm just going to abbreviate, guys, my manufacturing costs. I was going to abbreviate, but then I saw I could fit it in there easier. So manufacturing costs is what that says. Same thing, different name. Those are the things that go into our work in process. Now, what happens? As we go and we take those costs out of work in process, as they're finished, right? We're going to go ahead and, sorry guys, I guess I gotta write it up here. FG is finished goods. Finished goods do what? Finished goods, as we finish something, if you're finished with something, it's no longer in progress. Finish our work in process, when it's finished, you know, stating the obvious almost, goes from what? Goes from our work in process to our finished goods. And of course, the system is going to refuse to let me write right there. Okay, so that goes from my work in process to my finished goods, like that, right? And then as I finish things, I'm going to go from finished goods to cost of goods sold. So I guess I'm going to have to write my cost of goods sold. Not as I finish them, but as I sell them, I'm going to have to come out of my what? Out of my finished goods and into my cost of goods sold, right? As I finish my product. And when you're right here, you're just into basically financial accounting, as you're taking things out of finished goods and putting them into cost of goods sold, debit cost of goods sold, credit finished goods, right? That's finished goods inventory, right? Okay, all right, now all that just to point out, okay, that my amounts that go out of work in process, the amounts that go out of work in process, let's do this, amounts that go out of work in process, okay, and into finished goods, what do we call that? Remember, I was getting a little annoyed because I would ask that and you guys wouldn't answer me. Now you're really not answering me because you're not here. Is what? Amounts that go out of work in process and into finished goods are called cost of goods manufactured. Okay, by definition, the things that come out of work in process and go into finished goods are called cost of goods manufactured. Okay, cost of goods sold is the cost of goods sold, things that we sold for the period. Okay, and so I point that out and I go through that process there with you a little bit just to review how the costs kind of flow through the system. But also because it's easy to think of cost of goods manufactured as what you sold. No, it's what you manufactured. What you sold is what you sold. So it means it's the stuff that we actually finished, okay, during the period. Doesn't necessarily mean we sold it, okay? So the cost of goods manufactured accounts for what? Cost of goods manufactured accounts for the manufacturing costs completed during the period. Okay, cost of goods sold is the stuff that was sold. All right, now don't forget, even though I didn't show it here, we may have some salaries, for example, or depreciation potentially on the factory building and whatnot that will just go straight to selling and administrative expenses. So some salaries, selling and admin, and that's going to be expense, so it's going to go straight to the income statement, right? But it's just worth remembering, just so we don't ignore our selling and administrative expenses, and however you want to do that, debit, credit. That will be a debit though, John. We'll go over to the selling and administrative expenses, right? So some things go directly to expense. In other words, if they are considered a selling and administrative expense, same thing. Credit accumulated depreciation on the administrative building, debit selling and administrative expense. I'm not going to put another arrow up here because you're going to go crazy. Okay, good. So let's just go ahead then, and very important little box here. Okay, make sure you are comfortable with this. How do we calculate the cost of goods manufactured? Because you're not going to have time on the exam to do a whole, giant, little flow chart of T accounts here showing how things go. T accounts are not the way to answer questions on the exam, right? You need to quickly be able to analyze the elements of the cost of goods manufactured and then go ahead and calculate what that would be. So whatever was the beginning work in process, then what? We put in our direct materials, our direct labor, we apply our factory overhead, right? Just picture the T accounts that sitting there debiting into work in process, and then we have our total manufacturing cost for the period, right? Our manufacturing cost, or whatever was beginning work in process, plus our direct material, direct labor, our overhead, as we said on the little T accounts, right? And then if you subtract the ending, in other words, the amount that is still sitting in work in process, well, that's giving you what you must have taken out of work in process. And by definition, what you take out of work in process goes to finished goods. That's called cost of goods manufactured. Okay, and then of course from there it will eventually do what? That's the debit to finished goods, just to kind of see the relationship to what we were talking before. And then as we sell something, it comes out of finished goods and goes into cost of goods sold. All right, good. But you want to make sure you've got that sort of set up, and don't forget that's the factory overhead applied. Don't pick up the actual. Actual was debit to the manufacturing overhead. The credit that then goes to work in process is the applied. All right. Okay, good. So we're going to talk about how to calculate the predetermined overhead rate, but I'm going to go ahead and pause us for a second here. And we'll be right back and go ahead and continue this, okay? And for you, it'll just be a second as we hit play, or maybe you want to take a break too. Okay, let's go ahead and continue on and take a look at our way that we will apply our overhead. And remember, we said, hey, we have to use the predetermined overhead rate, and it's important to realize that predetermined overhead rate is an estimate, right? So we take whatever we think our estimated total overhead costs are. Maybe we've gathered some data from previous years. We talked about data analytics. We're not going to talk about it here today in our final review, but when we finished up the course, we talked about it in B6. And so there are ways of moving this big data, right? And maybe observing our total overhead costs over a series of years or months or whatever, and then using that to estimate what our total overhead costs are, and then of course observing the drivers associated with those overhead costs over that same period of time and seeing how they move, right? Okay, and we can literally use fairly, standard these days in, I don't know if I should use the word standard, but very accessible is in Excel. There's a way to do a regression analysis that will allow you to basically come up with a function, okay, for your overhead, so that you'll basically, and I always forget the way regression analysis uses they use different letters for the variables, but it ends up being represented by something like this: y equals mx plus b. It'll literally tell you a formula, if you will, using regression analysis in Excel for predicting your overhead costs. Okay. Now look, not everything fits perfectly on here, but that's what regression analysis does, is fit a line to that and tells you, the relationship. And we're going to talk a little bit later about variable coefficient and that sort of thing. Coefficient of determination, coefficient of correlation and whatnot later. But my only point here is that then you can come up with a way of predicting your overhead costs that'll allow you to come up with your predetermined overhead rate, and then you use that rate, say if it's direct labor hours, every time you spend some direct labor hours on a job, you also apply that overhead to that job using that predetermined rate. Key thing, remember, because problems will give you the actual and will give you the estimated. To determine the predetermined overhead rate, you have to use the estimated numbers. Okay, and then cost of goods sold is whatever our beginning cost of goods sold was. Cost of goods manufactured, by definition, guys, is the amount that comes out of finished goods and goes into work in process. So notice that for my not into work in process, but into cost of goods sold, comes out of finished goods and into cost of goods sold. And notice here that my my cost of goods manufactured is basically the bottom line they calculated here, right? Because they were trying to show you how to calculate on the exam, but it's what comes out of finished goods goes into cost of goods sold, right? So beginning cost of goods sold, I should say the beginning finished goods inventory plus the cost of goods manufactured, the stuff that, okay, let me say this right. The stuff that goes out of finished goods, okay, and into, comes out of work in process. Say it right, John. It's getting a little early here. It's either late or it's early, okay? But the stuff that comes out of work in process and goes into finished goods is called the cost of goods manufactured, okay? Let's say that right, okay? And then what happens? We have our beginning finished goods inventory. So it's worth realizing here, the account we're analyzing here is our finished goods, right? So to get to the cost of goods sold, you can analyze your finished goods by saying beginning inventory plus the cost of goods manufactured, goods available for sale, less whatever is left in our finished goods, means that the cost of goods sold amount is what came out of the finished goods, right? Okay, so this account up here that's being analyzed is work in process. Okay, so since I've kind of fumbled this a little bit, let me do this one more time. Okay, so what happens? We want to know the cost of goods manufactured. In other words, we want to know what came out of work in process and what went into finished goods, right? So we can analyze work in process. I guess I'll go ahead and call that WIP, since that's what most people do. Okay, work in process, right? So we have the beginning work in process. We add our what? We add our manufacturing cost, direct material, direct labor, overhead applied, That gives us total goods available, of course. We subtract what's left in work in process. By definition, what came out of work in process and went into finished goods, because we're done with it, is the cost of goods manufactured. The way we calculate that is by saying everything that was available minus what's still in there. That means we took out, right, to finished goods, okay? If we were being asked to, can determine the cost of goods sold, and they're giving us information for the finished goods account, we could analyze finished goods to determine cost of goods sold. So that's the beginning finished goods. The cost of goods manufactured, as we said, is what comes out of work in process and goes into finished goods. Less what's still in finished goods means that, hey, you've just figured out what you had subtracted from your finished goods to get your cost of goods sold. Okay? All right. In the question, I'm not going to ask you cost of goods sold and show you a cost of goods sold account, because obviously that's the debit to cost of goods sold. So they would show you information for finished goods and make you work your way back to the cost of goods sold. Okay? Okay, good. Now, if we are in a situation now, just kind of coming back, and I'm not sure I'm too happy with the way they load the information here, but if you take a look down here, okay, if the applied overhead is greater than the actual, then we will have an over or under applied. Well, if the overhead is greater, if the applied is greater than we over applied. If the applied overhead is less, okay, than the actual, then we have under applied overhead, okay? And over applied overhead is closed to cost of goods sold as a credit to the expense, okay? This is, as a credit to, they say, the expense, and cost of goods sold is not called an expense, it's called cost of goods sold. So we would do what? We would debit the over applied, credit cost of goods sold. Under applied, okay, under applied overhead is closed to cost of goods sold. We would do what? We would credit the under applied, we would credit the overhead account and debit the expense account for that situation. When we say the expense account, we mean cost of goods sold. I'm not sure why they're calling it to the expense. It's just called cost of goods sold. Why do we have to start putting another word onto an account name there? It's called cost of goods sold. We don't add expense to it. We know it appears on the income statement and has the effect of an expense, but we don't call it expense. We just call it cost of goods sold. Okay? All right, good. So let's go ahead and I'll tell you what I want to do right here is take a look at this question. Let's do that, okay? So why don't you, if you want to, pause, and then we'll come back and we will go through this question together, but I'm going to just go ahead and give you one to pause. 1, 2, 3, pause. Okay, we're back. Okay, and so let's just go ahead and let's take a look at this question. Now, they gave us a lot of information here, okay, and you could spend quite a bit of time, looking through something like this. You could probably figure out a lot of things. You could probably take the cost all the way through work in process and everything else with the way they give this to us. If they were to ask you to do something like that, it could even be in a task-based simulation where they give you a big bunch of information and ask you various things. Or it could be one of those where they give you a series of multiple choice questions that leverage off this same set of facts. The exam still does do that, okay? But let's just look at this, what they call the call of the question down here and see what they were looking for. So we've got this Clubbard Corporation, and they apply factory overhead at a rate of 40% of direct labor cost. Any over-applied or under-applied factory overhead is deferred until the end of the year, and Clubbard's balance in his factory overhead control account at the end of the year was. And so what happens? We're going to sit here and we're going to have our manufacturing overhead. They've given us the information. They would have to be able to even ask us this question of the amount that's been applied. They're going to have to give us the information of the actual, and it's going to be our job to see if they're under or over applied. Now, I'm looking and I'm thinking, okay, well, thank you, God, because what happened? The examiners were very nice to us. They simply gave us the actual. So if I can figure out the applied, then I'll know if it's under or over applied, right? So I sit here and they give me the rate 40% of direct labor cost. Okay, great. So do they give me the direct labor? So I start looking at this thing and I say another prayer and it is answered, because what happens? They tell me the direct labor. Since they told me the direct labor and they told me the rate, all I have to do is sit there and use the predetermined overhead rate, 40% of direct labor. 400,000 times 0.4 equals what would have been debited to my manufacturing overhead for 160,000. So now I've got what? Now I've got my actual, okay, and of course over here, just if you're wondering where the debits come from, okay, where the debit's going and other credits going, this is being credited to work in process. John, how long have you been looking at accounting? Okay, and you're still doing that, saying credit when you mean debit, okay? So we would have done what? We would have debited the 160,000 to the work in process, credited the manufacturing overhead, and then this would be various things. I don't know, for example, accumulated depreciation, whatever. I don't know, whatever constituted the various elements of their overhead. As I credit those, I would, okay. I am looking at this a little too early today, guys. So, and I don't feel like becoming John Director of the final review video. So just ignore those debits and credits that I just did, because I obviously got myself backwards, and I apologize for confusing you. Okay. So we have our manufacturing overhead account. That part was right. Okay. And we have what? We have the amount that was the actual. Actuals are over here. They gave me that. Actual. Applied is over here. Okay. And so the actual they gave me, that's a debit. The corresponding credits would be to different accounts. Okay, but let's just say, so we can keep that visual in our mind here, rent payable on the factory building, etc., right? Okay, and that's the actual. Okay, sorry. Okay, and then the applied, okay, the applied does what? It comes over here, and I don't need X's because I figured out the applied right here. The 400 times the 0.4. I think I made my mistake because I got greedy because I wanted to be able to just show it right there next to it. The applied is right here, 160,000. Okay. And this is probably going to happen in that there's going to be a difference between the actual and the applied. Okay, so now we've got our debits and credits straight here. And so what happens now, we come in and we have what? We have a difference of 15,000. And so since we have that difference of 15,000, what? We have more actual than applied. We are what? We are 15,000 under applied. The answer to this question. I apologize for getting those flipped there at the beginning. Now, what we were trying to say in the text when we were looking is what happens. You have to close this out to 0. at the end of the year. You have to close out your manufacturing overhead. And when I say this, your manufacturing overhead, that has to be closed out to zero by the end of the year. So we would have to credit the manufacturing overhead. We would credit that. And what they were saying in the book is, since we were under applied, we would debit the cost of goods sold for this 15,000. Okay, debit cost of goods sold for the 15,000 for the under applied. If we're over applied, that would mean that for the under applied here, we would debit cost of goods sold. If we were over applied, that would mean that that would mean that there'd be a bigger credit than debit. So to close this out, we'd have to debit the manufacturing overhead and we would credit cost of goods sold. And then they had the annoying thing that they kept calling that expense. Just call it what it is. It's cost of goods sold. Now, there is another way of allocating based on the relative amounts that are in each one of the accounts to the three accounts: work in process, finished good, and cost of goods sold. Because if you think about it, some of our overhead may still be in work in process, some of our overhead may still be in finished goods, and of course some is in cost of goods sold. So you may need to allocate it between those three accounts. So if you had the three accounts and a third of the total was in work in process, a third of the total was in finished goods, a third of the total of the three was in cost of goods sold, then you would go ahead and put 5,000 of the under over applied, in our example, if it was 15,000, in each of those accounts. Okay. All right. And sorry for getting those debits and credits mixed up. But when you looked at this problem, okay, you look at this thing and you're like, oh my God, this is the world's most difficult problem. And that emotion is what stops you from answering this, maybe more than the question itself, right? Because you just get overwhelmed and you start making mistakes. You saw how I did. I started going too fast and you start making mistakes and stuff. So you want to make sure that, you understand what the question is asking you, because we only use, 3 numbers out of this whole sea of information to answer this question. Okay. All right. Again, sorry for that, guys, for getting a little bit confused there on my debits and credits. Okay. I've only been looking at accounting for 30 years, so I'm still bound to make those kind of mistakes. Okay. All right. Good. Enough of that. Let's look and what we've really kind of been talking about, whether we called it that or not, to a large extent, is job order costing. Okay, as we keep track of cost by job, customized cars, boats, houses, those sort of things that are made to order, okay, are probably going to use a job order costing system. Okay, process costing, okay, that we're going to get into here now, is something that we use when we are talking more about homogeneous goods, such as chemical processing, paper production, fuel refining. Okay, we have this sort of continuous flow of goods. So we're not, and all the goods are the same. They're homogeneous. Okay, now you say, well, wait a minute. What if we have, high octane fuel versus low octane fuel? Those are different. Well, that's going to be a different batch. Okay, but each item that comes out of a batch that we're processing of a certain product is going to be homogeneous. So we call that process costing. Now, as you recall, we talked about the concept of equivalent units. Okay, and what equivalent units says is, look, we're going to give ourselves credit for things that we had in progress. So the things that weren't completely done, we're going to go ahead and say that we did actually complete those units by seeing what percentage done they are, and give us credit for an equivalent number of units. Okay. Now, there are 2 methods that we have to know. And to me, the hard part for me is neither is conceptually difficult. What's start to bug me is keeping each one in my mind at the same time and separating them, right? Okay, so we give you the way to calculate your equivalent units using FIFO And then we're going to look at weighted average on the next page. Okay, now FIFO is probably the more logical way of doing things. Okay, so what happens? We have our beginning inventory, and whatever percent was completed for the period, completed during the period, the work in process, the beginning inventory, times the percent completed, we give ourselves credit for that, okay, that we completed this period, okay? Then what? Then we take whatever units were actually completed, okay, for the period, and then whatever's in our ending inventory, okay, we give ourselves credit for what we completed this period. So we pick up whatever we completed this period, okay, for our work in process at the beginning, units completed, that's 100%. Ending work in process, whatever we completed this period, that's the equivalent units. Okay. Now, when you look at weighted average says, I don't care how much of the work that you did on the beginning inventory this period. We're going to assume you did all that work this period. So we say, hey, whatever you completed this period, we just assume you completed this period, even though you actually maybe started it last period. Okay, so we don't account for that work that was done last period under weighted average like we do FIFO, and then we come up with an equivalent units calculation for what we actually did this period. Okay, and that's our equivalent unit. So obviously you're going to get a different answer if it's work in process versus finished goods. I'm not calling out flashcards, guys, here, but I think you can see you absolutely have to know this, because nobody wakes up in the morning saying, oh yeah, weighted average method, yeah, FIFO method. You've got to flashcard that. You've got to put that on your flashcards. You need to look at that on exam day. You need to look at it the day you're sitting in your car going through your flashcards one more time prior to the exam. Okay, don't mess with this kind of stuff, guys. You've got to have them on flashcards. You've got to keep that information flowing through your DNA, okay, your brain, every single day that you get up to the days just before your exam, where you're sitting there and just repeating those flashcards over and over, because I promise you this will abandon you if you don't do that. Okay, good. Now you come over and you look at your cost now, the numerator, because we're going to come up with the cost per equivalent unit in this question. Okay, and so what happens? Well, we sit here, and since we're only giving ourselves credit for what we did this period, okay, on our FIFO method, then we only gather the cost we incurred this period. Okay, so just right here, right? The cost that we incurred this period, and then of course we divide it by the equivalent units that we had calculated using the approach for FIFO that we saw on the previous page. For weighted average, since we gave ourselves credit for the stuff that we had done in the previous period, and we gave ourselves credit for it as though we completed it this period, then we take the costs that are in the beginning inventory. Okay? All right, good. Just a quick thing, because I want to quickly get to the questions that we have to practice with here for this, so that while it's still in our head how we do this. But let's just take a look at normal versus abnormal spoilage. Okay, basically normal spoilage is part of our factory overhead, so it's charged to our inventory. It's a product cost. Okay, normal spoilage is a product cost. It just flows through our cost determinations as we've been going on. So we just dump whatever the cost was of those goods that were spoiled. We're just going to put that through work in process on the finished goods and into our cost of goods sold eventually. Abnormal spoilage, I don't know, something weird happens. Okay, there's a flood or fire damage or something. Those are expensed. Okay, there are period expense. Okay, all right, good. Come over and let's just take a look then. Let's practice with this weighted average FIFO stuff. And this is a good question because we get to practice with both. And if I'm getting this question on the exam, I'm thinking, okay, I'm going to go FIFO first and then weighted average. Okay, now that's how I'm thinking. You may want to do weighted average first, okay? But don't sit here and try to do both of them simultaneously is the key point. Pick one, do one or the other first, okay? So we've got this mass manufacturing, had 100 units in beginning work in process that were 60% complete, okay? Now, right away, I'm thinking, okay, if they were 60% complete at the beginning of the year, 1 minus 60% means that I'm going to complete what? 40% of that work this year on those, okay? The company completed 500 units during May, and 200 units in its ending inventory May 31st were 40% complete, okay? So this is for the beginning. For the ending inventory, what? And I'm just putting the 1 to represent 100% minus what? Minus the 40% complete at the end of the year means that what? That they have 60% to go, but you got to be careful. That means they completed what? They completed 40% this year, all right, during the year. So what am I going to do? I'm going to go ahead and for FIFO, I always think the pen decides to not write for me, right, when I'm trying to be in the middle of a thought here. Okay, so for the FIFO, what am I going to do? Well, I'm going to take the beginning inventory of 100 units. But what happened? Since they were, what, 60% complete, that means I'm only going to give myself credit for, what, 40% of that work under FIFO. So that's on an equivalent unit basis, 40 units. Then what? They tell me that they completed 500. But if they completed 500, right, we've already accounted for those 100 that they had, what, had started at the beginning of the year, and they only did 40% of that work now this year. So I got to subtract that 100. That's that same 100, right? I subtract that. That means that they started and completed a total of what? Of 400 units this period. Okay. And then I'm going to go ahead and account for what's happening in that ending inventory. And so what do I need to do? I have what? How many units? 200 units here in ending inventory. So I'm going to take the 200 and I completed what? They tell me I completed 40% of that work this period. And so under weighted average, I go ahead and I say, well, those are 40% complete. So 200 times 0.4, if I'm doing my math right, is 80. I add these guys up, and 40 plus 400 plus 80, if I'm hopefully doing my math right, should give me what? 520. Now, when I look at the choices, thank you, God, I'm done. If I'm on the CPA exam, I'm not doing weighted average because there's the 520, you know, and I can just pick 2. So I know 2 is the right answer, but let's just go ahead and let's just do weighted average just to complete the thought here, right? Okay, so now when we do the weighted average method, we're going to assume that we did all of the work on the beginning inventory of this period. And so they tell me that they completed 500. Yeah, I know that 100 were already in progress, but I don't care. I give myself credit for what? All 500 of that I've done that this period. And then I simply need to do what? Then I simply need to account for the work in process. So I take the 200 times what? Times the, again, 0.4. That gives me 80. Okay, again, I got that same calculation up here. So that's 580. And so I've confirmed that 2 is the right answer. And now I'm realizing I maybe misguided you a little bit, the coaching aspect here anyway, and that I probably should have do weighted average first, because weighted average is just what? 2 calculations. And if you only have one, if every choice has a different option like this did, then I would say, yeah, go with weighted average first, because it's really one calculation. Like you can do the applying the weighted average and adding them together, whereas you had to do 4 calculations over there for FIFO. So if every choice is different, maybe you need to start with weighted average. Okay, good. All right, now the next question is another equivalent units question, and they basically want what is the total value of the direct labor in the ending work in process inventory using the weighted average method. Okay, now basically you're going to be calculating your conversion cost and your materials cost here, and you could have different percentages being done for the different items. So be careful that you know what it is the question's asking you, because sometimes they'll give you the percent for materials, they'll give you the percent for your conversion cost, or in this case they're just teasing out direct labor. Remember, conversion costs are direct labor and overhead. So you got to be careful and know what they're asking you for in these questions and pick out the right percentages. If they're giving you materials and conversion costs together, then you need to look at the question and see what they're asking. And they're asking for, in this question, labor. I don't think they bothered us with materials information here. Okay, now, so we're going to go ahead and we're going to see what costs we have to pick up under weighted average. And I can tell you right now that I know I'm going to have to pick up both these numbers, the amount for the work in process at the beginning and the work of the process at the end, or the cost added for the period, I should say. So I've got to pick both those numbers up. So to come up with the costs that are in my, and I look at the question, there's dollar signs, so I know I've got to pick up one or two or both of these numbers. And since it's the weighted average method, I know in my numerator I got to pick up both of these, the 50,000 plus the 775. Okay, so I picked both those numbers up. I know I got to do that. Now my job is to just figure out the denominator, and since I'm doing completed weighted average, I should say, then I start looking and I see, well, wait a minute. The units completed during the quarter is just given to me there. They had 100, they started 500, they completed 400. So I don't even have to do that 500 minus the 100, right? I mean, the number of units that were completed, they just tell me straight out were 400. Now, just to do it the way the book showed us, okay, the way we practiced a minute ago, the beginning was what? The beginning was 100, and I give myself credit for doing the full 100 under weighted average. And then what? The units started and completed is what? Well, they completed, they started 500, and I already gave myself credit for those 100 up there, so if I subtract them, that's 400, okay, because they won't always give me that number, but that number was given right there, okay, so there's that, there's the 400 that were, the 100, so I would have said, sorry guys, I could have said the 500 units, the 400 units that were completed, but I already counted for those 100, so this would become 300, okay? But if they give you the units, that were completed during the period, you could have just picked up that 400, and then I have what? I have this 200 units work in process, okay? And the 200 units work in process, and they tell me that the ending work in process was 75% complete. So I go ahead and I multiply that times 0.75, and that's going to give me now what, the 150 units. Okay, so I gave myself credit for the beginning. I made my adjustment for the units completed, but I already gave myself credit for the 100, or I just could have started with the 400 there. And so I get a total equivalent units here of what? Of 550. Okay, so now I get my equivalent units, and I take that and I divide that by the 550. And when you do the math on that, you get an amount, okay, of $1,500. Okay, just doing that math, $1,500 per equivalent unit. Now, of course, to answer the question, okay, make sure you know what you're looking for here. We just want to figure out, well, what's the amount in the what? In the ending inventory. So ending work in process inventory. So I have to pick up what? I just pick up that 150 units. And the 1,500 times 150 units now are going to give me the right answer, which is going to be this 225,000. Okay? Okay, good. So again, the key thing here, because the second question that we worked wasn't really that much different from the first question when it came to the equivalent units calculation, was that we absolutely had to sit there and make sure we knew what cost to include in that numerator, right? Okay, okay, good. Activity-based costing. We spent a little bit of time with that, the bottles and cans things. Remember that thing? And then remember I showed you how I had kind of applied that to a medical example, whatever, but it doesn't matter what industry. Just remember that we had what? We had multiple we had multiple pools, and we had multiple drivers. Okay, and activity-based costing. And so the key thing is, instead of having one company-wide overhead rate or even department-wide overhead rates, we come up with a pool per activity, and we can get a more precise application of our overhead to our products and avoid a certain amount of cost distortion through that process. Okay. All right, good. Let's go ahead and let's take a look at this question here. And Nobis company uses an ABC system. Oh, I'm supposed to let you pause. Okay, welcome back. Okay, hopefully you worked through this question. Okay, but let's look at it together. Nobis company uses an ABC system. Which of the following statements are correct with respect to ABC? Okay, so Nobis company uses an ABC system. Departmental cost systems are a refinement of ABC systems. No, they're not a refinement. They are what? Assigning cost by activity. I wouldn't call it a refinement of departmental cost. Okay, you can have a departmental overhead rate, you can have a company-wide overhead rate, or you can use ABC, but they're not derivatives of each other or refinements of each other. Number two, ABC systems are useful in manufacturing, but not in merchandising or service industries. No, I showed you. We had the bottles and can example, and then I showed you how I used that as an example in the medical area. Okay. Number three, ABC systems can eliminate cost distortion because ABC develops cost drivers that have a cause and effect relationship with activities performed. So you look at that and you're like, okay, cool. I know that 3 is correct. Now, that number 1, I kind of ruled it out at the beginning, but let's say I'm taking the test and I'm clearly got rid of 2. And I'm trying to figure out, okay, any choice with 2 is out, and I'm sure that 3 is correct, right? So any choice that doesn't contain 3 or contains 2 is wrong. So there's 2 there, I got to get rid of that. 2 there, I got to get rid of that. And 4 doesn't contain 3, so I could back into it that way if I was a little confused about that first choice there, Roman 1 there. Okay, good. Let's go ahead and let's take a look at joint cost. Okay, and there were different methods for allocating joint cost. And remember, guys, as I said when we looked at the this information in the main text, we always got to call out that joint cost. I know that the joint cost is going to be part of my computation, so I'm writing that number down as soon as I pick it up. Then I just have to figure out, well, how am I going to allocate that number, right? So I start to look, and we're first looking at relative sales value at split off. So if we're having some product that at split off, we could sell it as it is, or we could sell it as one product or another at split off, then we could just go ahead and calculate the relative values at split off. And so 10,000 for product A, 30,000 for product B, total is 40, so a quarter of the cost will go to product A, since that represented 10,000 of the 40,000. And then 3/4 of the cost, since that represented 30 of the 40,000, will go to product B. And you can see they calculated 250 and 750 accordingly. Now, sometimes you can't sell a product that's split off. You just got a bunch of soles of shoes sitting there, and you got to continue from there to develop them into running shoes, whatever it is. So if that's the case, you could use the net realizable value at split off point. Okay, so under that scenario, now you have to consider what additional cost you're going to have to incur to complete those items. That gives you the net realizable value, because to turn this into a running shoe versus a basketball shoe, I'm going to have to continue to process it, right? So you take those additional costs off, and now you have the net realizable value at split off, and we have a total of 30,000. So what happens under this scenario now? Only a third of the cost will go, and again, you always got to pull out those joint costs. A third of the cost will go to product A, since it represents 10,000 of the total 30,000. And then for product B, we're going to go ahead and we're going to allocate 2/3, since it represents 20,000 of the 30,000. Okay, good. Now you come down, and you could use basically volume to figure out how to allocate